right, we got 2 more days until the FOMC meeting, and as we expected, today was a very extremely low range, but with a bias to the upside, and we probably will get something like that again tomorrow. That's the kind of market we're going into, heading into what is widely expected to be a rate cut from the FOMC. Of course, what are they going to do afterwards is what's the market's going to be keying on, and how dovish are they? Like, are they cutting rates because they want to, or are they cutting rates because they have to? And that's the distinction that traders are going to be making in terms of whether or not we want these cuts and are bullish from these cuts, kind of like last year, and mid-cycle adjustment, and they end up stopping and we keep going higher, or are they cutting because there's a train coming and they're trying to get in front of it and they can't stop it? Right, that's the cuts where they have to, and usually those kind of precede some rough patches in the economy and in the stock market as well. So that's what we're going to be watching for from the press conference, as well as the projections that we'll get at Wednesday's meeting. So until then, it's been a quiet day and a grind, and it doesn't mean that there weren't some interesting patterns developing. We'll talk about those, but we have a nice, good bullish bias. I mean, from a stock market perspective, this is the kind of day we like to see, like these grinding moves to the upside and a lot of good patterns. I'll show you what those are and why, and then we'll look at our trade idea of the day, which was in one of those broadening trade sectors that had been doing so well, but has not been doing so well here lately, and we're going to kind of trade its neutral pattern. So let's go ahead and get started. Today is Monday, September 15th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line is strongly bullish above the 96th percentile. So very strong trend there. The market sentiment still rising. This is what, how many days in a row now? So we fell on Friday, but 1, 2, 3, 4, 5, 6, 7 days out of 9 to the upside. And 4 of those days, 2 up days, 2 down days, we closed lower than the open. So we're getting some filled in bodies there. We tend to get those near the, when we are in a mature move, and that's obviously what we are in right now. Even on a near-term basis, you could argue we're in a pretty mature rally. That typically takes 7 to 12 days. And what do we say? We're 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 days into it. So you could say we're pretty mature in that as well. Especially without the momentum line ever getting in strong bullish levels, and we've been, pretty good bullish move. Now it's been a grind, and look at today's range. We talked about that the ATR is going to get really low today and tomorrow because the ranges should be really small, and we saw that. We saw that today, extremely small there. So that's why the momentum line's not really going anywhere, right? We closed, near the high of the day because we also closed near the low of the day because there just wasn't very much of a range. And so the momentum line, it went up because we rallied, but it still stayed relatively low because of how small the range was. And that's just the kind of market we're in, especially probably for at least one more day until we get through this FOMC meeting on Wednesday. We are going a little parabolic on the NASDAQ 100, you'll see here in a second when we look at the DMI, but on a short-term basis, you can see it's been a nice strong run off that bull tag. And it's just been every day to the upside, and we're up almost a full percentage point today. Again, very small range, about half of the average, and that average is really small. But we closed near the high, and so the momentum line is a little bit higher than the S&P because there's a little bit bigger of a range, and we did pop up with the rally. The near-term line, again, is very strong. Again, we never did get the momentum line this entire near-term rally so far. We never did get the near-term line above the 80th percentile, so it's been a very strong move without a very strong move, right, where we've just been kind of grinding our way up here. If I take a look at the Dow Jones Industrial Average, you'll see that, again, we have what's called, again, a bullish intermediate confirmation signal, where you have an oversold momentum line because we're actually kind of down off the highs from the last couple of days, even though we were up today by 1/10%. Again, very small range, about half of a very low average. But because of that, the momentum line, because of the small range and we're off the highs, the momentum line actually continued lower and is now in oversold levels. You can see the near-term line also out of bullish territory. and they're just still in the upper half of the chart, but out of bullish territory. So yeah, it's you would expect to get a bounce off of this, but again, any bounce we get tomorrow will most likely be very, very muted, and it's all going to be about how the market responds on Wednesday. Not so much to the rate decision, because it's widely expected the Fed will cut rates, but more to the projections that are released along with it, because it's September, as well as the press conference is probably the most important thing, how dovish he is for the rest of the year. The Russell is actually giving us a bullish intermediate confirmation signal, so it's another near-term high. This is coming off a near-term low that we haven't gotten on the large cap indexes, because the near-term line did get the bearish territory, but we bounced up, and the momentum line actually did get strongly bullish on Thursday, but we were so bearish on Friday, and then today very lightly bullish, that it brought the momentum line all the way down to oversold levels. So again, a bullish intermediate confirmation signal, but it's kind of offset by this bearish divergence, where we're getting higher highs in the index with lower highs. In fact, we've been progressively getting lower highs on the near-term line as we've been getting higher highs on the index itself. And so a little bit of a kind of a bearish, a little bit of a sign of a maturity, of a mature run, in this case a mature intermediate run that we've been on really since April the 8th, but we got that bull tag and we bounced right off of it, so it's a new leg, but even this leg appears to be a little mature in the rally that it's been on. All right, well, that does it for our Market Outlook preview video. You can unlock the full version of today's video at marketscholars.com. There's a link down in the description or the pinned comment below. All of our subscribers and Market Scholars get access to the full Market Outlook video, including our foundation tier members, which is our first tier at just $29 a month. You get access to the Market Outlook videos, the trade ideas that come along with them at the end of the video, the Market Outlook Live, where we put on those trades in real time, and then we manage other trades that we've done in previous videos and see whether we should get out of them or stay on them. And then we track the results of all those trades with our Market Outlook Live Trade Tracker. So all of that you get access to, again, for just $29 a month, or a little bit less than $1.40 per video. Again, thank you for watching. Remember, subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, share it with anybody else. Follow me on Twitter for more content between the videos at DavidSettle42. Check out the free blog post for today at Market Scholars. Again, this is a free subscription to be able to see the blog post. Get caught up on everything today really quickly in written format. It also has a Market Outlook preview there too, so you can get in the habit of checking that out every day. Have a great rest of your Monday night, everybody, and we'll see you all next time.